Are you curious about the differences between USDA, FHA, and conventional loans and which one might be right for you? In this video, we'll explore the unique features, benefits, and requirements of each loan type, focusing on credit scores and eligibility to help you make an informed decision. Let's start with USDA loans designed for low to moderate income borrowers purchasing homes in rural areas. USDA loans require no down payment and offer low interest rates funded by the US Department of Agriculture. To be eligible, the property must be in an eligible rural area and household income must not exceed 115% of the area's median income. While there is no specific minimum credit score required by the USDA, most lenders look for a score of at least 640. Loan limits for USDA loans are generally based on the property's appraised value and the funding fee. The property must be used as a primary residence. Next, let's discuss FHA loans, backed by the Federal Housing Administration and accessible to borrowers with lower credit scores. These loans allow for a down payment as low as 3.5% with a credit score of 580 or higher and 10% for scores between 500 and 579. FHA loans offer competitive interest rates, but this depends on your financial profile. Mortgage insurance is required with an upfront premium of 1.75% of the loan amount and an annual premium ranging from 0.15% to 0.75% of the average outstanding loan balance. For FHA loans, limits vary by county from $498,257 in low-cost areas to $1,149,825 in high-cost areas. The property must be your primary residence and adhere to FHA safety standards. Generally, a debt-to-income ratio of less than 50% is preferred, but some borrowers can qualify with a higher DTI. Now we have conventional loans which are not insured by government agencies like FHA or USDA and are offered by private lenders. Conventional loans typically require a higher down payment, usually between 5% to 20%. They often have better interest rates for borrowers with higher credit scores. For conventional loans, mortgage insurance is required if the down payment is less than 20%, but it can be cancelled once you achieve 20% equity. The minimum credit score for conventional loan is 620, but higher scores are preferred for better terms. Conventional loans are subject to conforming loan limits, which for 2024 range up to $766,550 for most areas, with higher limits in high-cost areas. These loans can be used for primary residences, vacation homes, or investment properties. Typically, a debt-to-income ratio of 36% or less is preferred, though some lenders allow up to 50%. When comparing these loan options, consider the down payment requirements, credit score requirements, mortgage insurance, and loan limits. USDA loans require no down payment, FHA loans requires 3.5 to 10%, and conventional loans typically requires 5% to 20%. For credit scores, USDA loans typically require a score of at least 640, FHA loans require a minimum of 560, and conventional loans require a minimum of 620. Mortgage insurance is mandatory for FHA loans regardless of the down payment amount. For conventional loans, mortgage insurance is required if the down payment is less than 20%, but it can be cancelled after reaching 20% equity. USDA loans do not require private mortgage insurance but have an upfront guarantee fee and an annual fee. Loan limits for USDA loans are based on the property value and funding fee. For FHA loans, they vary by county, and for conventional loans, conforming loans limits apply. USDA loans are ideal for low to moderate income borrowers in rural areas. FHA loans are suitable for those with lower credit scores and smaller down payments, and conventional loans offer more flexibility but require higher credit scores and down payment. By understanding your options and taking steps to improve your financial health, you can find the loan that best suits your needs. Thank you for watching, and be sure to like and subscribe for more valuable insights on home loans and financial planning.